Hello and welcome to Portfolio Matters. Tonight we have a treat because we have lecturer from the LSE, Pete Cirenza, adding a touch of class to our paltry efforts. And we will be discussing the long-term outlook for interest rates. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Right. So I have just finished reading The Great Demographic Reversal by Goodhart and Pradhan, and I was inspired by its discussion of the long-term outlook for interest rates. But there were parts of the discussion which, frankly, were slightly beyond me. So I thought we'd get somebody who actually knows properly about economics, Pete Cirenza, lecturer in economic history at the LSE, who has very kindly agreed to come on tonight. So the key determinants of interest rates going forward. Now, economic management becomes much harder when real interest rates exceed growth. So if rates exceed growth, the debt burden is growing. Now, currently, of course, rates are very suppressed and much lower than growth. So governments of the world can run a fiscal deficit and actually maintain a real rate of debt. So the debt burden is not growing. And actually, you could run a steady fiscal deficit with low interest rates and see the debt burden shrink. Some definitions. By definition, savings must equal investment for the world economy.
So and can I chip in there, please?
Yeah.
Say I don't really understand that, because if I were to borrow, let's say, £1,000 from the bank creates that £1,000 by a double entry bookkeeping process, and I can then put that money in my bank account. And it is a saving, but there is no. I guess what you would say is the bank has invested in my debt. Is that the way it works?
The assumption is that to the extent that you put savings in the bank, then that is going to be invested, right? So I think that you have to assume that the money is then invested, that it doesn't stop when you put it in the bank, Richard. And the money, and if you're in effect borrowing from the bank, the bank has in effect other people's savings that form the basis of the loan that they're making to you, right? So there is a certain equality, I suspect, in this, that there equilibrium between savings and investment.
Pete, can I just come in? My confusion comes down to the question of how this kind of growth accounting, national accounting works. So if we have an economy with a GDP of 900, let's say, and the central bank prints 100 and then gives it to the government, which spends it on building bridges. So the bank has created both an asset and a liability. It's increased the money supply by 100, and that 100 has gone into investment. Do you agree it's gone into investment, or is that consumption?
Well, again, certainly if a government is building bridges, that certainly feels like investment to me. And presumably the central bank is, expanding its balance sheet, right? So it's expanding its balance sheet by 100. And and that then creates in effect the savings that can then be invested, right? So the central bank's balance sheet is in effect the saver, and then the government is the spender, or
Yes.
the investor, if you will.
Okay, so the central bank has been able to create savings.
In effect, right? In effect, yes. And so, for example, the U.S. Federal Reserve, it recently, right, has been expanding its balance sheet very dramatically through quantitative easing, and that has then generated this expansion, or depending upon what securities the central bank is in effect buying, and they're in effect doing the savings in that instance.
Yes,
and
absolutely.
In the U.S. example, the at the end of every year, any net earnings of the central bank actually go back to the government, which is kind of where the benefits of the savings ultimately go back to the government.
Okay, so I kind of understand that first case where the central bank has created money and it's created a liability and an asset, and then the government has spent the savings in the form of investment.
Yeah.
But in the second case, so let's start again with an economy with GDP of 900. The central bank prints 100 and gives it to the government, who then buy shares on the stock market. Nobody actually spends physically in the economy. So I would say then that the central bank has created savings, but there hasn't been any investment. So that's impossible. So how would you explain that?
Yeah, in looking at that example, it struck me that there's presumably an assumption that when the cash, so the government buys shares from a seller,
mm-hmm.
right? People, as you say, and the proceeds of that sale get deposited. So presumably there's then an assumption that deposit will then be invested by, the bank, right? So
it's very similar to the example I quoted, isn't it? Where I borrow £100 from the bank, who create it through a double entry bookkeeping process, and I then deposit in my bank account, and is it then working its way through the banking system in some way and becoming investment at some point? But it's not obvious how that happens. And it's a bit like it's an equality. It sort of seems to make sense as an equality, but it's not a precise black and white equality, is it?
Well, the thing is, I think a lot depends on how you define investment. Is investment, so you have created a borrowing, yeah? So in order for somebody to borrow, somebody else must have saved. And is essentially, if you are defining all investment as just having borrowed off somebody in the way that, for example, the government invests in, say, social security expenditure, which I believe is actually what is defined as investment, then essentially investment is defined as all borrowing. And for all borrowing, you have to borrow off somebody. So somebody must have saved. That is my understanding.
But actually, I'm not sure I agree with the all borrowing must come from someone else, Keith, because if I own a bank and I want to lend you £1,000,
yes,
as long as I have the reserves that I'm mandated to have by the government, I can do as a bank. I can do a double entry bookkeeping, which creates an asset and a liability. I have the asset, which is a loan to you.
Yes,
and I have a liability, which is the £1,000 that I put into your bank account that you now owe me. And you have £1,000 that is in your bank account that you can go and spend. And the money has been created.
Yes.
And then it gets destroyed when you pay your debt back.
Yeah.
So there is no counterparty who has lent £1,000 apart from the bank, which has created it via a bookkeeping entry.
The bank has created both. So, but the thing is, these accounting identities occur at an aggregate national level. And in that case, you would say you have created savings and investment, wouldn't you? In that the way that emerging market economies can fund themselves by growing by bank debt, by the banks creating money supply. And so you are creating savings by creating essentially future liabilities, borrowing from the future.
Right.
Are we actually getting anywhere with this? Should we skip on? So let's just take it as read that we've kind of tried to get to the bottom of this, and I think we've got so far. If any of the viewers can articulate this better than we can, please can they send us a comment? Okay, so anyway, so savings, it is a given that savings must equal investment for the world economy. The other given is that global interest rates are co-integrated. What that means is if the US raises interest rates, it will have the effect of raising interest rates around the world, because money will flow from countries with low interest rates to countries with high interest rates as savers chase returns. And that will have the effect of depressing rates in the US and raising rates elsewhere. Another definition that Goodhart and Pradhan make, and is debatable, is that, so they take a classical view of interest rates. So they take a view that interest rates are determined by the demand for money. So interest rates are determined by the variations in the desire to invest, which varies a lot around the business cycle, and the desire to save, which doesn't vary very much across the business cycle. And the difference between the two causes the interest rate cycle. And the real interest rates balance desired savings with desired investment. So those are the starting blocks.
So what happens when a central bank comes in and starts to do yield curve control? They disrupt the process, do they?
They do disrupt the process, and they cause a lot of, the classical economists would say they cause a lot of malinvestment, and because they knock the interest rate market, the market for money, out of equilibrium.
I mean, it's a good question, and we've seen a lot of it for about 12 years now, right? Since the global financial crisis. And yeah, and I think, Keith, you're right. I think the impact, if it's a material action being taken by central banks, and we've had very material actions being taken, then it does have impact on interest rates and on the economy. So the page that you had where you're saying that interest rates were determined by these high amplitude variations and desire to invest, well, those are then impacted by the central bank, right? And if the central banks show up with enough firepower, either actual or that they tell the market that they will make available, that can have a big impact on interest rates and can have the effect of creating scenarios where you get, quote, malinvestment, right? So where you have kind of the discipline of the market is in effect mitigated, reduced because of the significant central bank action.
Well, I think what the Fed or the central banks would say is that when the economy can get stuck in a liquidity trap where, in Keynesian terms, the desire for money, for liquid assets, because people are scared of investing, the market is out of equilibrium and so they need to reduce interest rates below its natural equilibrium level to get people to actually start investing and the market to the economy to start growing again. It's liquidity preference. Sorry, that is the phrase I'm after. investors are essentially afraid of the future. Everyone hoards money. Their liquidity preference goes up. And so in order to reduce their liquidity preference, you need to penalize them for holding money.
I think that's right. And obviously, realistically, there are investors, or people willing to make credit available. There may be a desire by policymakers to have that credit available at lower rates, right? And then you get the central bank coming in, right? So and then the outcomes can be can be impacted by the degree of the central bank intervention in terms of how far you move from where the market forces would set credit for different borrowers.
Okay, so bottom line of the whole Goodhart and Pradhan book is they believe that interest rates are likely to rise in the future because of the decline of globalization and adverse demographics. Now, to understand their argument, they're saying that declining interest rates since 1981 demonstrate that savings have exceeded investment over that period. And
so, sorry, can I just interrupt you? Because we're saying that savings equal investment. So how can they then argue that savings have exceeded investment?
That's true. But what they're saying is that interest rates have had to fall continually to balance savings and investment. And because there have been a lot more savings, then the real interest rate has fallen.
So the investment rate, the borrowing rate has fallen.
Yes, that's right.
Counterbalance the excess, if you like, of savings.
Exactly. So that's
and you can argue that excess of savings comes about through an excess of debt or an increase in debt.
Actually, no, not in this case. Actually, let's go on. I think you'll see what their argument is.
So can I just ask why would that not equate to the increase in debt?
Let's go through, and I think you'll see what I mean, Richard. Well, what Pradhan and Goodhart mean. Okay, so they're saying is that savings rate was high because China was building up its FX reserves. Okay, so it ran an artificially low exchange rate, had a very large current account surplus. Yeah, and it exported. So when it runs a current account surplus, it is not importing as much as it's exporting, and the gap is financial assets. So it is building up, buying financial assets around the world. So essentially, it was exporting capital. The other reason was the globalization exacerbated inequality. It increased the wealth of the upper and middle classes, and the rich are more likely to save their marginal income, whereas the poor have a higher propensity to spend. So exacerbating inequality increased savings.
So Keith, if I could just make one point here, which, and again, I haven't read the book, but the inequality they're referring to is within country.
Yes.
And some of the other phenomena they talk about are supranational, because inequality on a global basis is declining, as you would expect if people on lower earnings in many developing countries start doing a bit better. That's actually done a lot to reduce global inequality.
That's true.
In this particular point, they seem to shift from a global savings equal investment to a domestic inequality measure, which I think is interesting.
Well, I think that they're talking about essentially the demand for money in the US. So the US will then export its interest rates around the world. Okay, anyway, what they're saying is going forward, all these things are going to unwind. So the big thing they're talking about is an aging population. So as the population ages, it no longer saves. It dissaves. So it has to spend its retirement pot. The public sector will need to continue spending. In fact, it'll need to probably increase its spending on social and healthcare. And workers will have a higher dependency ratio. So they will be less able to save because they will have to support grandma and granddad and their kids. And also inequality will decline in part because of the unwinding of globalization. And as globalization unwinds, so workers will have more bargaining power, more wealth will go to workers, and that will mean they will spend it rather than save it. So
I guess there's some quite chunky assumptions in there, aren't there?
There are.
That they've made. So more will need to be spent on social and healthcare, possibly true, but what is the trade-off between improving technology, improving efficiency of healthcare? And we've seen, I think in the last 12 months, we've seen some remarkable improvements in the efficiency of the healthcare systems in the developed world because they're pressurized to do so. Declining inequality, but we've got artificial intelligence coming in, and artificial intelligence could be a powerful force for increasing inequality.
If I could jump in here, I think because I find this quite interesting, because presumably the assumption that the authors are making is that you're not going to have structural changes in the economy owing to innovation that changes the nature of work in some way, right? Because I certainly look and see whether it's artificial intelligence or whether it's the not yet arrived but coming in the next decade autonomous vehicles potentially having very significant impacts on the nature of work.
Yes.
I mean, the other thing that strikes me with the pandemic that we're hopefully reaching the end of here is that, we found that a lot of people can work very well from home and not being in the office. And so it doesn't take much imagination to get to the point where you don't even need immigration in the future, because you can have workers in other parts of the world providing labor to economies that need labor, via Zoom, like the three of us are doing right now. So I would be a bit more optimistic in a sense about the potential for the increased labor productivity and in effect that we may enter an economy where we don't need people working in quite the same way that they have in the past. Another way of saying this is I'm not sure I believe that the power of labor will be as strong in returning as they do.
On that note, Pete, you may have seen the recent academic paper which looked at real wages in Japan over the last 20 years, showed that actually been declining despite the adverse demographics. Now, Goodhart and Pradhan have an explanation for that. And their explanation is that over the period, Japan essentially exported all its jobs to China. So rather than demanding more labor within Japan, they got more labor from China. So they outsourced a lot of the manufacturing, etc. And instead of paying higher wages in Japan, they simply paid higher wages that got the job done in China. Well, their argument is that interest rates are going to decline in the future because inequality is going to decline because we are retreating from globalization. Now, globalization decreased interest rates because it introduced vast numbers of low-skilled workers into the world economy. And this eroded the wages of low-skilled workers and increased the wages of high skilled workers and increased inequality, and therefore increased savings, because rich people have a higher propensity to save. So there's then a savings glut, depressed interest rates. And then China has been building up its FX reserves. And you can see from the period 2000 to 2014, China exported a lot of capital. So all that, as it built up its FX reserves, it was essentially buying US treasuries and buying the government bonds of Western democracies, flooding them with cash, forcing interest rates down. But it is no longer a big purchaser of US treasuries.
Can I just ask a question here? Because I don't quite understand this.
Yeah.
So if you assume that China hadn't done that, it hadn't existed effectively,
Yeah.
and that the products were made, let's for sake of argument, made in America,
mm-hmm.
then the effect would have been the same, presumably. The total GDP would have been the same. The savings would have accrued to presumably businesses and their profits, and would have been deposited in US bank accounts. So this might seem a naive question, but what's the difference? Why is it different that China did it to the US doing it itself?
Well, I think what they're saying is that China's savings glut forced US interest rates down, and I think you could say created a great deal of malinvestment in the US. This is one of the causes of the great financial crisis. If you read, Ben Bernanke's books, he would blame a savings glut. So artificially low interest rates causing overinvestment in subprime lending, etc. Essentially, with interest rates that low, then you could afford to take much more risk than you would otherwise have done.
And interest rates were low because China was buying all these treasuries.
Yes, it was buying everything and anything.
But I think, Richard, just one other aspect there is that, one step before the savings is the fact that when China became more integrated into the global economy, it led to more trade, right? And it led to a bit more specialization, with more activities being done in China and then exported quite successfully elsewhere. And there are benefits to trade. There's a lot of studies that suggest that when trade rises as a percentage of GDP, that it does bring enhanced economic growth. So it's not just that China had a bunch of savings and bought U.S. treasuries and that lowered interest rates, but there were benefits to China's being integrated into the global system. But one of the big impacts was then this very significant purchase of U.S. government bonds and the lowering of interest rates and more marginal lending activity taking place in the United States than would otherwise have been the case. So you could also make the case that in hindsight, obviously, with better regulation, you might have seen a reaction to the savings glut in the form of regulatory action to limit higher risk lending, which did not occur, obviously.
So they're saying that China is not going to be such a big exporter of capital in future, and its savings ratio will decline because it has an aging population. In fact, it has a very rapidly aging population as a result of the one-child policy. And also culturally, they tend to have quite integrated families, and the one child will then have quite a dependency burden going forwards, because they'll have to look after parents and children. So they're saying that China's savings rate will massively decline, with knock-on effects around the world.
I.e. increasing interest rates?
Exactly. That's right. So the whole argument is interest rates must increase going forward because of these very slow but inexorable demographic and macroeconomic, like trade effects.
So what happens if productivity increases massively as a result of automation and
Yes,
technology?
that would offset it. That would mean that your productivity growth should mean that you don't have to bid up for workers' wages.
Yeah.
So that would decrease inflation.
No, I think that's absolutely right. I think that's one of the big assumptions is by assuming that you won't have structural change or increasing labor productivity as a result of technological change and so forth. Obviously, it's very difficult to predict these things. There was a very famous economist, Robert Solow, who commented in the 1990s that that basically that there were computers everywhere, but productivity, productivity didn't move. And then almost when he was done typing it, labor productivity actually did react and started increasing a bit. There's a bit of a delay between kind of the introduction of new technology and widespread adaptation and then productivity growth. So we'll see, I guess.
The impact of their predictions are that the public sector will not be able to run as big deficits going forward because real interest rates will rise. And so they're going to have to either reduce entitlements, reduce discretionary expenditure, both of which are very difficult. I mean, discretionary expenditure has already been squeezed as Western governments have privileged entitlements. You only have to look at the UK government and the triple lock on pensions and how it's cut legal aid, etc., to protect pensions, or raise taxes, all of which are very difficult.
Yes, presumably the third is the least difficult.
Well,
and cutting spending is quite challenging. Politicians are much better at courageously spending money during crises than they are doing the reverse. So that is quite a challenge, actually.
Yeah,
because certainly in our lifetimes we haven't seen very many government programs that have been scrapped, or it's quite and even the austerity that everyone talks about, for example, in the UK. In actual figures, in terms of the overall government spending, it was not dramatic, even though the impacts in certain places were dramatic in terms of particular cuts that were made.
Absolutely. So the summary of this discussion is this table here. So this is how Goodhart and Pradhan and we, and this is all open to debate, think the demographic trends and the trends they've talked about will impact real interest rates going forward. So number one is Goodhart and Pradhan are saying that there will be a lower global savings rate because of an aging population and lower savings in emerging markets. Do I agree or disagree?
Well, can I just ask, what about India? Because India has got a burgeoning youthful population.
Yes.
And it's exactly the opposite. And it has the potential to grow into a huge economy over the next couple of decades. That's
true. Absolutely. But I don't think the shock of having all the Indian workers come into the global economy will rival that of the impact of China, because actually they've already been in the world economy for a while. I think you'd have to say that you'd need to find a replacement for all the Chinese workers who are now becoming more middle skilled rather than low skilled. So you'd have to say that the whole of Africa, etc., became integrated into the world economy.
Well, I think on this point, I think there is an argument to say that globally, we are aging, right? So the demographic transition has been running its course in different ways in different places, but fundamentally we've in most parts of the world, we've gone from high fertility, high mortality to low fertility, low mortality. And, populations are aging. And so I think it is the case that as you age, you just save, right? You're spending your, so I do think I think that is the case that these factors should lead to a lower global savings rate than previously.
I agree. But the other thing about an aging population is that as pension entitlements become weaker, then people will tend to work longer. And we're already seeing this. You're seeing that actually up to the age, I think, of about 65, you're seeing quite high participation and rising participation rates. It's after the age of 65. You think the age of 70 is when actually people struggle to work longer. You're having struggle to get people above 70 to stay in the workforce.
Yeah. And obviously people have other reasons to want to work. And if they're living longer and healthy and able to work, then that's probably also a good societal thing as well.
Now, the next point is that Goodhart and Pradhan are saying that there will be an increase in investment, in part because governments will have to borrow more to fund healthcare and social services for an aging population. But there seems to be a contradiction here in that they are both saying that there has to be a decrease in savings and an increase in government expenditure, which they have ruled out.
Why have they also... Sorry, Keith. Why have they got an end of corporate deleveraging? Because I wasn't aware that corporates have been deleveraging.
No, neither was I, frankly. But
well,
in Japan, no, to be fair, in Japan, they have been. In the US, they haven't.
No.
But actually, and if you look at the aggregate numbers in the financial system, absolutely has been deleveraging ever since the great financial crisis.
Right.
Yes.
So
that is very much the case.
Now, they're also saying, and this is where I really disagree with them, that there will be no change in portfolios. So there'll be little change in regulatory preference for government bonds. So governments will not make any change to the regulatory regime. So banks will still be encouraged to buy bonds, but above all, investors will retain their preference for government bonds as safe assets. And I think that is a very strong assumption. If real interest rates started to rise, you could see a mass repudiation of government bonds, which would send real interest rates flying. And the thing is very fragile and unpredictable. It's volatile. And as inflation rises, I think the system could become rapidly unstable, as it did in the 1970s. And actually, that comes down to my problem with their whole argument. And their whole argument is that, there are these very long-term trends which are going to change interest rate expectations, real interest rates. But what is far more important is market expectations. And with the amount of debt in the world, changes in interest rate expectations will lead to a great deal of market volatility, and actually the markets will be the ones who determine what interest rates are rather than these long-term trends.
Yeah, no, I mean, ultimately markets determine rates, and governments and central banks can impact markets, as we've seen a lot in the last decade or so. But I think everything you said is absolutely the case. And it does feel post-pandemic we're in quite a delicate position with sovereign debt levels having become more elevated, and that all works okay in a zero bound interest rate environment. But if inflationary expectations and interest rates start rising and the cost of debt starts rising, then that can then lead to some significant volatility, and then you're kind of in the kind of the Carmen Reinhardt risk of point of no return for sovereigns, which
Yes.
which would obviously only further increase volatility. And in that context, the notion that investors wouldn't change their preference for government bonds wouldn't make any sense, obviously.
Yes, absolutely. I would push back on my own argument, though, by saying that, over the last decade, interest rates have been relentlessly downwards. And that would seem to indicate that there are these big macroeconomic trends which have, such as globalization and demographics, which have created a savings glut and therefore depressed interest rates. And I can't have it both ways. I can't be saying, well, markets, market investor expectations are the prime determinant of interest rates. And then, previously, clearly macroeconomic trends have depressed interest rates. And then going forwards, I'm saying, well, actually, the main determinant is going to be markets, not macroeconomics. Whereas historically, it would seem that macroeconomics very much have determined interest rates.
Right, but presumably you would think that markets are always every day trying to figure out what they make of macroeconomic trends.
Yeah.
Right, and what the impact's going to be on. So it's the market. Ultimately, it's the market interpretation of both macroeconomic trends as well as government statements. Right. One of the really interesting things was, back at the start of the pandemic, the central banks were supporting, down to investment grade or even maybe one level below investment grade bonds. And they made public statements to that effect. The amount of non-investment grade bonds that the central banks ultimately bought was minuscule, but it was just the statement that they might that impacted market behavior, and markets reacted by rallying for double B's on up, rallied quite dramatically from April onwards on the back of virtually no actual intervention, but just the potential of intervention.
Okay, so let's wrap up. So the other things they're saying is that productivity growth, which we've touched on, due to IT and AI, will increase real interest rates. I can't see that.
So you would expect it to increase GDP.
Yeah.
But you'd expect to do it in a non-inflationary way. So real GDP will go up relatively more quickly.
Well, productivity growth should surely depress interest rates.
Really high future labor productivity growth in developed economies would offset some of these other factors of aging population and China's role and so forth. And that the inflationary impact of workers having more pricing power would be reduced by higher productivity.
Precisely.
On the other hand, there is a correlation between productivity and wages. It's really generally only through higher productivity that wages can rise.
Yeah.
But again, in the context of this argument, it would seem, productivity growth would seem to undermine this notion that you're going to have this inflationary pricing power of labor growing in the future. And that to me is the really interesting question: is that the case? because it wasn't that long ago that a lot of people were worried that we were going to very quickly become a society where everyone was doing virtual reality because they had nothing else to do, right? And that wasn't very long ago.
Yeah.
So and hours worked has certainly been coming down, and leisure time has been rising since the Brits invented it, 150 years ago or so. And so maybe those trends continue, and those are deflationary trends that would reduce the power of labor. So it'll be interesting to see. That to me is the really interesting, assuming that it doesn't really have an impact, and then you just have more labor power in the future, might be a strong assumption.
To wrap up, I think we each in turn give our view on the long-term, the impacts of these demographic trends on long-term inflation. Now, so I'll start. I would say that I think that they have a point, that adverse demographics, the increase in the dependency ratio, and an elderly population, they certainly will have lower savings, and the retreat from globalization will have the effect of raising worker wages in the West. So you will no longer be able to outsource as many low-skilled jobs to China. All of that is inflationary and should raise interest rates. However, I think the primary effect will be, as interest rate and expectations rise, will be the markets will anticipate everything and the whole system will become unstable. So my main prediction would be more instability.
So I think that the long-term demographic trend is quite a powerful disinflationary trend, and I think that you can have spikes in inflation that may last a year or two, but I think that the overall trend is a disinflationary trend, and the instability that is being caused by the vast amounts of government debt in the developed world. I think it's very hard to determine how that is resolved. If governments determine that they want to try and inflate it away, then my view is that they are fighting a demographic trend, but they may be able to achieve some inflation. That creates interest that results in interest rates going up temporarily. But they don't actually want interest rates to go up, because they're trying to create inflation. They would like interest rates to remain lower to propagate the inflation. And I think that at some point the world needs to deleverage, and how it does it is very, very difficult to predict. So it's my problem with this, I suppose my difficulty with the arguments that they've put forward is and I haven't read the book, so I may be doing them a disservice, but from what you've told us, Keith, they appear to be applying some quite rigorous principles to what is an extremely complex, interrelated problem. Actually, and I'm not sure how valid that is.
So, I just ask, Richard, why do you think that we're in a deflationary environment? And why do you think that the demographic trends they have identified and they're saying are inflationary, you're saying actually they're deflationary? Why?
Well, because there are fewer young people who are driving economic growth via setting up families, households, buying houses, buying consumer goods and so forth. Mm-hmm. As you say, older people are not spending so much. I mean, I don't count myself as old, but I haven't bought a new car for 10 years. I'm very happy with the one I've got. And so the aging population tends to spend less, I think, as a disposable income. So, and they are dis-saving, so they're being careful with their expenditure. There is an inflationary environment. You either have cost push or demand pull. Well, I don't think we have demand pull. And cost push, as I say, we may get it in a sort of cyclical basis.
But the thing is, Richard, and I completely understand your arguments, but I'm just trying to concentrate on the real interest rate portion of this argument. And their argument about real interest rates is that an elderly population will save less, will be dissaving. So because there's less savings, then as long as investment stays up, then interest rates will have to rise.
Yeah, but if consumption is dropping, this is the assumption.
Yes, no, you're right.
Then don't need the investment.
Exactly. No, that is true. So, but if you count government expenditure as investment, then governments will either have to cut expenditure or interest rates will rise. That's their argument. So, Pete, your turn.
Well, listen, I think, Keith, what you just described is troubling, and I'd agree with a lot that both of you just said. Because again, we're starting from a fairly weak, position in terms of the kind of elevated levels of sovereign debt in a lot of places. I mean, in my view, in terms of inflation, if we are going to see it again, and we haven't seen it in 40 odd years, none of my students, unless they grew up in Zimbabwe or somewhere, Venezuela, have ever experienced inflation in their lifetimes, right? But if we're ever going to see it, we're going to see it, quite soon. And then the question is how sustainable? Because to me, I can see a post-pandemic, lots of demand, lots of forced saving, because there's only so many things you can buy online. And, I could see a post-pandemic rise in prices due to very strong demand alongside of monetary and fiscal, stimulus and some, kind of reshoring economic nationalism. But, I'm not sure it's sustainable. And because I'm not personally, I struggle with the notion, that labor will have more pricing power, because I'm just not convinced that's the case. Certainly, other than in a handful of occupations, if you're a good computer coder or you're very good at scoring goals in football, there's not a lot of places where workers seem to have a lot of pricing power. And there's certainly a lot of trends, that would suggest that, that there could be technological changes that have big structural impacts, because something like 15% of the global workforce is involved in some driving a vehicle in some form or fashion. So, if we do get autonomous vehicles in the next 10, 15 years, that's a big structural change. So that's the piece that I struggle with, but certainly lower global savings seems plausible. And the risk that you described, Keith, would be quite troubling. And, yes, you would have market instability, but it would put governments in a very difficult position to sustain their, their fiscal position. So that would worry me.
Okay. Well, I think we're going to wrap it up there. And thank you all for listening to that rather rambling exploration of the demographic and globalization trends and how they're going to affect real interest rates. Thank you very much to Pete for coming on and sharing his expertise with us as we explored this issue. And I hope you all enjoyed that, and will press like and subscribe to the channel. In the meantime, it is goodbye from us all.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.